Welcome. This is a video describing how I use historical data from Yahoo Finance, the S&P 500 daily prices, to see where the equities market is in its market cycle, to know if we're going into a downturn of the stock market, have we bottomed out, and are we back into a recovery for an uptrend of the stock market. So that's the purpose of this video. I'll walk you through on how to use Yahoo Finance historical data of the S&P 500 within SierraChart. But first, we're going to see my previous analysis back in March of 2015, and today is February 11th of 2016, so this is almost like a year ago. Impending market crash of 2015 through 2016. Using the GSPC, which comes from Yahoo Finance Historical, plotted monthly on SierraChart, we get the following price action of the S&P 500. And these are the indicators I use, which is the MACD moving average, the solid blue, the MACD difference, the dotted line, and the Arun, the orange-yellow line. In order to get a fix on whether the market cycle is really telling us correctly, I went back to the various crashes that have happened in the past. So around 2000, September around 2009, we have the dot-com crash. And how do the indicators display that? The dot-com crash is exhibited by the MACD entering back into the mids. What are the mids? If you were to look at these horizontal lines, the brown line is the zero. The dashed lines around the brown line is called the danger zone, and the green lines around the danger zone and the zero are the mids. Those are just terms I use in order to know where the market is as it cycles through the ups and downs. So here, the MACD of the S&P 500 plotted monthly entered into the mids. The MACD difference is below the MACD moving average, so I know that yes, a downtrend has begun, and the Arun remains below the zero, telling us that the downtrend still continues until the Arun goes back outside the upper mids. So this is the dot-com crash, and it didn't recover until the Arun goes outside the upper danger zone to go outside the upper mids. So recovery didn't occur until May of 2003 for the dot-com crash. The other calibration point, just to make sure that our historical analysis and the studies I use within the historical analysis kind of tells us the truth. Once again, the housing crash happened on September of around September, October, November of 2007. And as you can see, the MACD moving average, the blue line, solid blue line, bounced off the upper mids going down. The MACD diff is below the moving average. The Arun is below the zero. And the angle of the moving average MACD is very steep. And as you can see, the Arun doesn't make any excursions up back through the danger zone until the recovery, which occurred on May 2009. So back in March of 2015, the reason I did this historical study is because I was asked by an asset manager if I was willing to put all of my assets into their management, and they were going to place 70% of my assets in equity. And I wanted to know where we are on the market cycle back on March of 2015. So I did this historical study and found out that, the moving average MACD has already created its highest peak, and the MACD diff has dipped below. And that's telling me that an impending crash was coming. So why would I want to buy expensive stocks or mutual fund in equities just to lose money? It didn't make sense to me. So therefore I declined the offer for this management firm to manage my assets and told them I'm just going to remain in cash because a downtrend is coming. What else do we see? We see that the Arun already has been below the zero and will continue below the zero. So an impending crash was going to happen. So I told my Sangha trading group, if you are in equities, move out and go into bonds. And that's also what I did. I made sure I remained in bonds or cash and had minimal equities in my portfolio. So that was the previous study. So now the question we ask is, where are we on this downward cycle that began way back in March of 2015? And we're going to answer that by actually, I've already done the analysis. So let's look at it. So I downloaded the daily information and plotted the S&P on a monthly bar chart. I applied my analysis, the historical study collection, and this is what it looks like. So once again, I did a sanity check to find out, does it match what the dot-com crash has done? And yes, it does. We bounced off or entered into the mids, and the mids here are these white thin lines. And the moving average MACD headed towards the zero, and the Arun created what I call the chair back, where the Arun exited the lower danger zone and headed towards the lower mids. So right there, the crash, dot-com crash, had begun. And the dot-com crash did not end until we created the lowest possible valley of the moving average of the MACD. And the Arun went out of the upper danger zone and into the upper mids. So recovery didn't occur until May, according to this one, 2003. Now I went to the housing crash. On the housing crash, we see the familiar chair signature of the Arun, whereas here we had the lift signature of the Arun, where the Arun got out of the upper danger zone and into the upper mids. Here on the housing crash, we have the chair signature of the Arun, where the Arun exited the lower danger zone and entered into the lower mids. And as you can see here, the Arun pretty much went sideways way below the mids, as the MACD moving average headed towards the zero, with the moving average difference below the MACD moving average. And recovery didn't occur until we got this lift signature of the Arun, where the Arun exited the upper danger zone and into the mids, as the MACD moving average created its lowest valley around June of 2009. So now we looked and see, where are we now? So this is the present, around February of 2016. I'm calling this the oil crash. Why? We look at it and see the Arun signature of a chair back, where the Arun left the lower danger zone and entered into the lower mids. We see the downturn of the moving average MACD as it re-entered the upper mids, and the MACD diff is below the moving average MACD. The moving average MACD, the black and white here, in this case black, is hitting the zero, while the MACD diff has already crossed through the zero. I fully expect the Arun to remain going sideways below the zero as the moving average MACD goes through the zero to complete its downward cycle. So the answer is, where is the equities in terms of the market cycle? It's still in the midst of its down cycle. We haven't even begun the bottoming out. So my advice to you, if you are in equities in your investments, just hang on. There's not much more you can do. It's too late to get out, because you should have gotten out when I gave the warning back in March of 2015. However, don't buy any more equities, because you're going to be paying for it at a higher price just to lose value. That does not make sense, so don't do that. So, in summary, we're in an oil crash, and we haven't even bottomed out. Many blessings to you. Now, the next section of this video is how do we do the analysis using SierraChart and the historical information from Yahoo Finance. Number one, bring up your internet browser. Number two, go to Yahoo Finance. Number three, click on Symbol Lookup. Number four, look up GSPC. Number five, click Historical Prices here on the left menu. Number six, make sure that the Daily Radio button is selected and scroll down to the very bottom so that you can click on Download to Spreadsheet. The spreadsheet would have been downloaded. Go show in folder because we're going to rename it and copy it into SierraChart data. We will name it 2016 because I use a dated file name. Today is the 11th, and this is going to be historical GSPC and I already have one, so we can't rename it that way, so I'll just put a 2 behind it. Let me get this one out of the way because I did this step early this morning and now it's the afternoon. There we go. Let's change that name back. There, no conflicts. We're now step 7. Copy this into SierraChart data. And I already have a file there, so it'll warn us of a conflict. Let me get rid of the browser. We don't need that anymore. Okay, what's going on? We didn't want it there. Let's go to data. Repaste again. There we go. Replace the file in the destination. Now, we can't use it yet because the dated price action is from the newest to the oldest. We have to reverse and resort the daily price within the comma delimited file. So double click on it, and if you have Excel installed, Excel will open up so that we can resort the date. As you can see here, the date is newest to oldest. We want to click here on the upper left so that the whole spreadsheet is grayed out. We want to go to data, sort, and we will sort the columns by date, and the order is oldest to newest, so we say OK. And there you go. We're going to exit and save all. Save. Save. Yep, keep the normal format. Very good. Now, the Historical.StdyCollct is a SierraChart study collection file that is the analysis that we will apply on this historical data of the S&P 500. The way this Historical.StdyCollct was created was through the chart book or the trading charts that I use for my daily futures trading, and I'll show you how that was created. But you don't really need to know and to create that on your own, because the Historical.StdyCollct can be downloaded from my blog site, and I'll show you my blog site so that you know where this can be downloaded. So you have the analysis file to apply to the historical data. The blog site is songhalivetrades.blogspot.com. Once again, songhalivetrades.blogspot.com. And look for the entry, where is the equities market going? And at the bottom of this blog site is a link that allows you to be able to download the historical study collection so that you can apply it to the historical S&P data from Yahoo Finance. So this is what will happen when you click on that link. Internet is slow, or my computer is slow, either one. Go to the upper right on this menu dots, click on it, and select download so that you can download the historical study collection. There you go. Or you can click the download. Well, no, the download button wasn't there. So once again, click on the menu button, select download, and that'll begin the download of the Historical.StdyCollct that you need to copy into SierraChart data so that we can apply it to the historical daily prices of the S&P 500. So we're done here. You now know where to find the Historical StdyCollct. So now we start SierraChart, and we will read in the historical information that we've downloaded from Yahoo Finance of the S&P 500. We wait for the SierraChart to start. Now we go to File, we go Open Historical Chart, and we will select the CSV file that we resorted so that the dates are in ascending order instead of descending order. We will open, and that's how the data will look. Now we need to go to chart settings because there are certain changes that we need to make because we don't have the whole date range that we want. So we will use date range and copy it from up here from March 1st of 1950 to February 2nd, 2011. February 10 of 2016. Jesus. The other thing that we're going to change is the chart bar period will be monthly, and the appearance draw type is going to be candlestick bars. And there you go. Now, once you've downloaded the Historical StdyCollct and placed it into SierraChart data, let's show you that again. So here we are in SierraChart data, and there's your Historical data StdyCollct. You will see it under Analysis. You will see Historical. Apply it. And there you go. Now, you will see that the Arun is just hugging the 0. We need to change the tuning of the MACD scaling here. So we go right-click, choose Studies, go to MACD Lot Scaled, double-click on that, and right now the multiplier is 1700, and that's way too large. I already did this analysis earlier. I believe the multiplier should be 0.5, 0.5. We apply that, and there we go. Now, if I were to calibrate this better, I would make the MACD, which is the black and white, the MACD moving average, enter into the mids for the start of these market crashes. So 0.5 is too small. We go to studies, we go to scaled, MACD lot scaled, probably 0.7. Let's see if that'll serve us better. Let's make it about 0.8. Yes, 0.8 or 0.9. Okay. Because right here, the start of the dot-com crash, as the black and white MACD moving average enters into the upper mids. Here we have the chairback signature of the Arun, where the Arun goes down through the lower danger zone and into the lower mids, and that's essentially the start of the dot-com crash. The dot-com crash kind of wanted to do a recovery here, where we created the lowest valley on the MACD moving average, but it wasn't done yet. We have another chairback signature, and a lower valley was created by the MACD moving average here. And then the recovery of the dot-com crash did not occur until around June of 2003. And here you have the lift signature of the Arun, where the Arun leaves the upper danger zone and enters into the upper mids, as the MACD diff is above the MACD moving average, and the upcycle has begun. And as the MACD moving average remains above the zero, that's your recovery continuing. And the recovery tried to do a slight abort here because you've got a chair back, but no, we didn't go into the danger zone. The MACD moving average did not go into the danger zone, but remained flat, going sideways, which means continued trend. The uptrend continued from that dot-com recovery. Next, we have the moving average MACD, the black and white, bounce off the upper mids. That's the start of the housing crash. And I would say it probably began right here on November of 2007. Once again, you've got the Arun chair back signature, the back of the chair, where the Arun leaves the lower danger zone and entered the lower mids. The MACD diff is below the MACD moving average, headed towards the zero, and that's a very steep angle. And the difference here is that the Arun stayed below outside the mids, going sideways, as the housing crash continued to manifest. And it didn't bottom out until here on May of 2009. And then we have the lift signature of the Arun, where the Arun goes outside the upper danger zone and into the upper mids. The MACD diff, the blue line, is above the MACD moving average, and the recovery began. And when the MACD moving average remained above the zero, recovery continued until here, where I said back in March of 2015, I noticed that we had topped out. We created a peak, and we were entering back into the lower, headed towards the mids, telling us that a downtrend was coming. The down cycle of the equities market was coming. And as you can see here, as we scroll to the edge, what do we see? We have the Arun chairback signature, where the Arun exited the lower danger zone and into the lower mids, as the moving average MACD entered into the upper mids, signifying that the downtrend has begun. And the downtrend still continues. We're still in the midst of it. We don't know where this is going to bottom out, but we still have more down to go. Why? because the Arun is going sideways below the zero. The MACD diff, the blue line, has already crossed through the zero with a nice angle down, and the moving average MACD, the black and white, is planning to cross through that zero to continue on its downward cycle. So that's the analysis. We will lose more monies in the equities market. So it's too late for you to get out. Just if you have equities in your investments, just hold on to it. It's too late to get out. But do not buy any more equities, because you'll be paying at a high price, which will continue to lose value until we bottom out on this market, on this current equities down market cycle. So we're still in the midst of the down cycle, and we haven't bottomed out yet. And a bottoming out will be seen when we see a lift signature of the Arun going up through the danger zone, up through the upper danger zone, headed for the upper mids. So that's not happening. The Arun is still just plain going sideways below the zero. So continued oil crash. We are in a continued oil crash. Oil crash is just my term for it. So that's it. Many blessings. Hopefully this video shows you how you do historical analysis actually of any symbol from the Yahoo Finance, applying the historical analysis that you downloaded from the blog site, using SierraChart to do your analysis. Many blessings, and we'll see you next time.